Yeah, let's go ahead and get going. Yeah. So again, thank you for being here tonight. We promise to be respectful of your time. We're here. I'm Ryan Johnson with GenWealth Capital Group. We are a multifamily real estate investment firm based in Houston, Texas. We're here today to present Lakeway at Swisher. It's a 348 unit multifamily mixed retail development project in Lake Dallas, Texas. Before we get into the details, when we had our first webinar in January, we were talked heavily about the Texas Triangle and our investment thesis in only investing in the Texas Triangle right now due to a multitude of reasons. But in addition to that, we talked about just the overall goals of GenWealth Capital, and one of those goals were to strengthen strategic relationships and partnerships that were already existing, as well as to find new strategic partners to continue to do deals with. And we had that as a goal of our firm because we were already working with the Revision Masters Group on a development deal. To kind of look back even further, John, one of the principals of Revision Masters, has been the key principal or the loan guarantor for 3 of our existing value-add multifamily deals. So we really value that relationship. And a key principal doesn't give you his signature just to anyone. He doesn't just meet someone at a bar and sign a multi-million-dollar loan. Their relationship was developed over many years, and we're glad to have him as a partner. And when we got this land under contract last year in Conroe, they were the first group that we brought it to because they had a robust multifamily development pipeline. They had existing vendors and architects and engineers already in place. They had processes were already in place, so we basically just plugged that project into their system. And we work with them weekly, with their team, with city officials, with their engineering and architectural firm. So we just strengthen our synergies and our working relationships, and we're happy to partner with them on this development deal in Lake Dallas, Texas. So a little bit about the opportunity. It's 348 units. This is an off-market land acquisition. It's going to be 17 acres of multifamily and 6.2 acres of retail. It's in a path of progress market of Lake Dallas, Texas. And what I really like about this deal is that it has retail pads that are going to be sold off to retail developers. And none of those funds from the retail pad sales are included in the pro forma returns. And so that's just icing on the cake. If I believe there's one of the gas station already has a PSA executed to 7-Eleven. There's an LOI that's been executed to a franchise tea company. And so those seem to be in demand, and none of those are included in the projected returns. So some highlights on the parcel. It's off a highly trafficked Swisher Road, a few blocks from I-35. It is the last large acreage parcel in this pocket or in Lake Dallas. The land is already entitled and it's already in zone. So versus in our Conroe deal, it wasn't entitled, it wasn't zoned, and the city changed the zoning regulations before we can get the plan submitted. And so it just didn't work after they changed the density requirements. This has already been green lighted by the city. And so it's been de-risked from an entitlement and from a zoning perspective. It's going to include commercial retail, quick service restaurant, and retail pads that are going to be sold off. And we already have the full civil engineering doc set, survey, geotech, and Waters of the United States report. And you might think, oh, these are just documents, but these documents take a lot of planning, a lot of collaboration with multiple disciplines and city officials and state officials and county officials. And so these take a lot of out-of-pocket funds, as well as just a lot of coordination to get these things done. So we'll watch a little video before we continue. Keep moving on here. All right, so we're going to introduce the teams now, because teams matter when you're trying to, whether you're trying to buy a value add multifamily or do a large development deal. Teams matter. So we're GenWealth Capital Group. We're based in Houston, Texas. I'm the director of investor relations and oversee construction management. Our partner Brian, he's not able to make it tonight, but he oversees finance and he's the lead underwriter. And Juan, he's on today.
Yeah, thank you, Ryan. So Juan Vargas here. A pleasure to be here with you guys. My role with the company is mostly on broker relationships, strategic partnerships, overall business strategy, and asset management. Been with the company. In 2016 is when we started. Right. So a little overview of the portfolio. A little over 1,600 units that we have acquired. Over 2,500 units that we have in a transaction volume that is through acquisition and through disposition. You can see here there's 5 deals that we have gone full cycle on. You can see there on the right, 86%, 60%, 40%, 17, and 245% average annual return. Across those 5 deals is an average of about 90%. We do have 3 current deals that Ryan mentioned just earlier that we still have, that we still own and operate, and where John Montero with Revision Masters is a key principal. So I guess we'll kick it up to you, John.
Yeah, we'd like to introduce their team here. Go for it.
Merrill, I'll let you start off and then I'll go after you with the following slides.
Sure. Everybody, my name is Merrill Calliser. I live in Frisco, Texas, along with John and Jeff, and we're definitely boots on the ground on this particular project because it's only about 15 minutes from where we live, driving distance. I'm a commercial real estate and SEC lawyer. I've got a boutique practice that focuses primarily on buying and selling multifamily, developing multifamily, and then the SEC portion is raising capital. We provide the Reg D offerings and the PPMs. Actually had the pleasure of representing Ryan and Juan prior, and so I've got a good working relationship with them. Real quick background, I got into a single family residential 8 years ago when SFR was popular. Partners some hedge funds. We grew a very large company and bought over a period of 7 years, almost 10,000 single family homes, switched over to multifamily in 2020, started going, COVID came, got a little nervous because I'm actually a former corporate bankruptcy lawyer and very conservative, saw that Texas wasn't really shutting down and ran into my buddy and partner, John Montero at a Starbucks, one of his favorite places. During COVID, started talking, got together, and formed Revision Masters and been acquiring existing and getting into development projects over the last 18 months.
Thanks, Merrill. Thanks, everyone, for joining us tonight. My name is John Montero. I, too, live here in Frisco, Texas, very close to the subject property that we're going to be talking about tonight. I moved to Texas in 2009. Prior to that, spent a lot of time in the Bay Area in the tech space, but always have taken my savings and bonuses along the way, even while working for other corporations, and always invested in real estate. So I've been involved in real estate for over 25 years. When moving here to Texas, really transitioned into the multifamily space, and we do both acquisition of existing assets, but a heavy focus on development projects, and we'll get into those reasons as to why we are doing that, why we think that's a good business to be in at this point in the economic cycle. The other folks on the slides, Jeff, our COO, he's on tonight as well. You'll hear from him a little bit later on. Our CFO, Tandy, and Anna Kelly, who's our other principal chief strategy officer for the company. She could not be with us tonight. Next slide, please. So very quickly, this is our current portfolio, over 7,000 units, just over $1 billion worth of assets under management. These were acquired over the last year and a half. So we've been extremely active in the multifamily space. Again, primarily focusing on the Texas Triangle markets. We do have a couple assets in Raleigh, North Carolina. That market acts and feels a lot like the Austin market. So we have a few assets there as well. Next slide, please. This is our new construction at the top. These are our projects that we have in the pipeline in various stages of the development process. We'll go over a couple pictures here in a minute on one of these projects that we should be having people moving in the next couple of weeks, which is super exciting. And then on the bottom, Merrill mentioned earlier, he had a single family aggregation business with a lot of the hedge funds out of the East Coast, and incredible volume here, did over 9,500 single family homes. Next slide, please. So I always say that, because I'm an investor as well in deals, and I always say team first, market second, and asset third. And what I mean by that is I always say that the team is the most important of those three factors. So this is obviously GenWealth and Revision Masters bringing this opportunity to you this evening, but we have a lot of other partners involved. A few others on the development side that are extremely important are our civil engineering firm, Bowler Engineering, based out of Frisco here as well, and Investwell Architects. They're a firm based out of Katy, Texas, in the Houston submarket, who has been a phenomenal partner of ours for all of our architectural work. So again, we feel really good about the team and the progress that we've made so far on this project. Next slide, please. Who's doing this slide? I think Merrill, you're on.
That's me. So just want to go over some highlights on the opportunity. We do this on all the presentations in case people aren't able to listen to the entire presentation. We just kind of summarize. So real quick, this is a Reg D 506C offering. For those of you that aren't as familiar with that, that simply means you've got to be an accredited investor. And if you have questions on what an accredited investor is, actually you can type it in the Q&A, and I'm happy to answer that. But I think most everybody on here knows what that is. So this is the first tranche of capital raise. So those coming in right now are getting a preferred treatment versus tranche 2, which will probably happen in about 12 months. So the first tranche, we have 3 classes, class A, B1, and B2. A is already full. So we have classes B1 and B2. They're divided by the dollar amount. The minimum investment for B1 is $150,000. The minimum for B2 is $50,000. And as you can see, obviously, if you put a little more money in, you get a little better treatment on the preferred return, which is annualized, as well as the splits between the member and manager. So it's a 10% preferred return, 80-20 split, up to an 18% IRR. And then we split 50-50, manager member. And then if you're coming in at the 50,000, it's 50,000 to 149 to be exact. The preferred return is 8%, and the split's a little bit more of the manager, 75-25. And then you can see we're not opening classes, the C classes yet, but you can see in 12 months, the returns are in the available splits are going to be a little bit less than they are right now. Obviously, we always prefer larger checks versus smaller checks. But you can see the member manager split goes from 75 all the way down to 65%, because at that point, a lot of the hard work has already been done, and we're going to favor those that come in early. With that said, we do have a very limited number of spaces. This is not a huge capital raise, so those of you that are interested, we would recommend that you get in sooner than later. We will have a wait list. We typically do have a wait list, but there's no guarantee that anybody on the wait list is going to get in. It's my legal disclosure. And then real quick, as Ryan had said, it's 340 units. We're projecting 905 square feet as an average per unit. We're anticipating this being completed, Q4 of 2025. Sounds like a long time off, but it's less than 2 years and 3 months away. That's really not a long time in construction world. This is Lake Dallas ISD in the county of Denton, one of the fastest growing counties in the state of Texas. Acreage is 22.23, and it's going to be a typical Class A garden style. It's going to have a resort pool, clubhouse, fitness center, dog park, electric chargers, and we keep adding more to that as more and more people are buying electric vehicles. It's going to be 3 stories garden style. Next.
Okay, this is my couple of slides here. So as I had mentioned earlier, we do have multiple ground up projects running. This is the furthest along. This is called the Everson Luxury Apartments in Katy, Texas, which is just west of Houston. These are just a couple pictures showing that you can see how far along we are. Our property manager is actually moving on site next week. We have our temporary certificate of occupancy, and we'll have tenants actually starting to move in first week of May. So extremely exciting. Next slide, please.
John, real quick, just wanted to add that we have the same architect firm on this project as the Lake Dallas project, so people can see what type of designs that they do. Yeah,
and there she is with the hard hat there in the picture on the top left. There's Meryl as well. We're extremely hands-on, so we're on site a lot, making sure that the project is being built on budget and on time. We also have an owner's rep that gets involved in the construction management, keeping everybody honest, fighting change orders, and just making sure that we're delivering the best product possible. The renderings on the bottom there, we do a lot of design work. We have a design firm that comes in. We do a lot of brainstorming on what we want the look and feel of that apartment community to look like. And so those are just some of the renderings and color schemes that and color boards that our design team puts together. Next slide, please. This was actually taken about a week ago. So this is the actual lobby and leasing office. Just a couple more touch-ups that need to get done, but we're almost there. Next slide. Couple more as well. The image on the left is just kind of an area to kind of hang out. We'll have some office space there, and the ability for the community to kind of get together for either business meetings or Zoom calls or community events. On the right-hand side, you'll see there again, just finishing off one of our units, stainless steel appliances, hardwood floors, and hard countertops as well. Next slide. So why do we like new development? I'll go through this very quickly. We feel that the market conditions are right. As we all know, interest rates have been going up. The Fed has been hiking. Mortgage rates have been going up. And obviously inflation has been an issue as well, especially for tenants. It's great for us as landlords because inflation pushes rents up, but from a tenant base perspective, more of their salaries is going towards to paying the rent. So we're in a cycle that is going to kind of ease off in the next couple of years, and so this is a perfect time for us to actually start these projects, work on the construction. And then ultimately, when we're delivering the new product, we'll be back, humming again, while all the way along the way, jobs and population is going to continue to flood into this marketplace. With new construction, we're buying by the acre and selling by the square foot. So again, we're buying dirt by the acre, and by the time that we're finished, leased up and stabilized, and getting this out to the market, we're selling it by the square foot, and that just is a massive value add, where the returns are definitely going to be shown to our investors, in the next couple of years. Best in class partners, as I'd mentioned earlier, we've got a vertically integrated team folks that we've been using and partnering time and time again. Our relationship with Juan and Ryan and Brian have been very strong over the last couple of years, and we're super excited for them to be partnering with us on this opportunity as well. Next slide, please. And then the last thing here, and before I hand it off, 4 development risk buckets. When you're looking at a development project, there's 4 primary risk buckets. There's entitlement risk, there's financing risk, there's execution risk, and then once we're ready to exit, what does that refinance or exit risk look like? I'm not going to go into a lot of details here. You will actually get a copy of the deck and the recording tomorrow that you can spend some more time looking through all of these different bullet points. But I just want to focus today on the entitlement risk. We don't like to bring in any investor money until we know that entitlement risk has been kind of put to bed. We have been working on this project for almost a year with the city and with all of our, civil and architect. And we basically are now at a point where entitlement risk is behind us. We know what we're going to be able to build. It's already approved and zoned and entitled. And so now we're ready to come to the market and offer these great opportunities to our investors and to GenWealth's investors. And so that entitlement risk is basically completely been de-risked. And the rest is really less of a risk in new development. But again, I just wanted to make sure everybody understood that the biggest part of the risk in any development is entitlements, and we're well beyond that point. Next slide, please. Hand it over to Juan.
Appreciate it, John. Yeah, so in this slide, we're going to be going over the housing shortage and the supply and demand imbalance, and also the costs for owning versus renting. You can see there in the top left, we're going to start with that chart, but you can see we have an undersupply of 168,000 units, and that includes single family and multifamily. For Texas specifically, with all the population growth that we've had over the last decade, it's even a bigger problem for us as far as the undersupply is concerned. You can see here on the top right chart, you can see here it's the absorption rate in the thousands. Absorption rate basically meaning units that have been leased and they're moved into. You can see here over the last 5 years, it has really increased in a dramatic way, with over 700,000 units absorbed over 2022. Now, these charts and graphs over the next few pages, they're for 2022, so they are a little bit dated, but the information is still true through 2023. We just don't have any slides to be able to share and share the information with, but it's very, very similar story. You can see here on the bottom left, and that's basically a graph showing the cost for a mortgage payment versus rent payment. The mortgage payment being in blue and then the rent payment being in orange. You can see here in 2022, we have about $1,000 gap, meaning that it's much easier, much more affordable. It provides much more flexibility for residents to be able to rent versus purchase. Especially here with the increased interest rates as well. It made it that gap increase even further. And then finally on the bottom right, you can see the vacancy has really decreased to an all-time low at 2.4%. Next slide, Ryan. Population growth and rent growth. On the map, there are 10 green dots, and these are markets that are having like the largest population growth throughout the U.S. 4 of those happen to be in Texas. Texas happens to be the market that we focus on exclusively. Us as a GenWealth team, Revision Masters, for Texas, they also focus on the Texas Triangle, which consists of Houston, San Antonio, Austin, and DFW. And so it's really good just to know that, being in Texas, being within the Texas Triangle, and you're having, 4 major metros that are all having, all top 10 in population growth. And then on the right side, the rent growth. Really what we want to fill here is the gap between the Class A apartments and the Class C. Class A being just under 18%, and then Class C at 9%. And of course, when we build and when we develop, it's a Class A multifamily development, and so that's really the story here is there's a big gap between Class A and C, which makes it even more favorable for us and investors. Next slide, Ryan. Commercial real estate risk versus reward. Let's start with the red and the orange on the right side. Those indicate higher risk. Shopping centers, lower tier shopping centers, urban office, senior housing. And then on the opposite side of the spectrum, you have life science, biotech, warehouse distribution, manufactured housing, affordable housing, and suburban multifamily, which happens to be the sector that we focus on, the asset classes that we focus on, and specifically suburban multifamily, both from a value add standpoint and a ground up development standpoint. And really, how does it differentiate from one side to the other side? Really it's from performance through the various market cycles, and how it has continuously come up on top. Why Texas? Why are we developing in Texas? There's multiple reasons. We're just going to go into a quick four here. First of all, we live here. We're local to the markets. Each one of these markets is local to us. With specifically regards to the fixed triangle. It's a market where it's a state in a market where we have low corporate taxes. Lowest in the nation, or among the lowest in the nation at 21%. Affordability here in Texas with the housing prices and costs continue to be one of the lowest in the nation year after year. And then the location, not necessarily where it pertains from a city standpoint or a submarket standpoint necessarily. What we're talking about here is from a map of a national standpoint, and where Texas sits compared to the rest of the U.S. is pretty much in the center. Yes, in the south, but in the center with regards to the West Coast and the East Coast. And so, what does that do for us? How is that helpful? Well, there's corporations that continue to move here because of the lower corporate taxes. They continue to move here, and it helps the corporations from a logistics standpoint. Being able to travel and provide services, product, from the center of the U.S. to the West Coast or the East Coast, but also from a talent standpoint, where Texas is able to attract, fresh and very, educated students, newly educated students into the workforce much easier because it's right in the middle. And then last but not least on this slide is the corporate rent. Here in Texas, we have some of the lowest corporate rents, and so that's it helps corporations move here and have lower operating costs and expenses. So this slide really shows a bunch of stats, and I'm not going to go through all of them. This is going to be shared with everyone, so we'll let you guys go through all of these, but I'll just point out a few, starting from the left side. What we like about Texas, well, number one, it's the number one U.S. exporter for 20 years in a row, with $375 billion in 2021 alone. We've had over 14 million people in the labor force. It's the 9th largest economy in the entire world, meaning that it is larger than many countries out there. It's Texas is the leading destination for companies relocating from other states. Right there in the middle of this slide, and pretty much goes back to what I just discussed. A lot of corporations relocating here from the West Coast, the East Coast, and it just becomes so much easier because we're right in the center. And then it's a leading job creator with just under 700,000 jobs added in 2021 alone. And then it's home to over 49 Fortune 500 companies. It actually has 54. So this slide is a little dated, but it's actually 54 as the latest numbers. Next slide, Ryan, please. So we're going to dive into DFW here a little bit more. So on the left side, it's the fourth largest metro economy. DFW is home to over 7 million residents, and that number is expected to grow to over 10 million by 2040. It's home to over 22 Fortune 500 companies, and in DFW alone, and also home to over 42 Fortune 1000 companies. It's the fourth largest metro by population in the US, and DFW has the third busiest US airport. And here on the right side, I'm not going to go through all these details. Just wanted to point out a couple of things here. Number one is the trading partners for the DFW market. We have North American countries, Canada, Mexico, and then we have Asian countries, such as China, and European countries as Germany, Netherlands. Those are major, countries that DFW alone is doing business with and exporting product to. And it's the 27th largest GDP in the world and the fifth largest in the US. And then here at the bottom, it just, at the bottom, it was just showing the diversity in the jobs for the DFW market. Ryan? Looks like you're muted, Ryan.
Sorry about that, guys. I couldn't unmute myself. Yeah, so Juan kind of focused on the Texas Triangle and DFW. I'm going to kind of focus down on just a little bit more into the submarket of Denton County. Denton County, it's interesting in that, I-35 splits around Hillsborough south of Dallas, and it wraps, the west side goes through Fort Worth, the east side goes through Dallas. They converge again just under the city of Denton. And as you can see here, this circle is the Lake Dallas development deal here. And so a lot of frontage road here on I-35. Denton is the home of Texas Women's University, one of the larger women's only, universities in Texas. It's $80 million of research done in the Denton County area. 12 live music venues. Denton Municipal Electric owns the electric provider company, and they produce 100% renewable resources. Looking at the satellite view, here's DFW Airport. It's about 30 minutes or 25 to 30 minutes south of the Lake Dallas development. You have Louisville, which has completely exploded over the last decade. I think the population is around 120,000 individuals. Frisco, this is where the Revision Masters team's home base is, about 15 minutes from the development site. Home to about 200,000 people. Again, exploded over the last decade. If you like the Dallas Cowboys, you like to live in Frisco. A little bit on the demographics of Denton. The median family income is higher than the average, family in Texas and the United States by over $30,000, as well as the per capita income is higher by about almost $10,000, higher than the state of Texas, higher than the United States. So just a growing population, solid income area, job growth, and in the path of progress, because over the last decade, Louisville has exploded, Frisco has exploded, and just that North Texas corridor in general is just the growth projections are just exponential over the next decade. So this dives down even into just a 1 mile radius, and this is the CoStar report. 2021 or 2022 population of Lake Dallas was about 9,000. Some of the notable things here is just the growth for the last 5 years was 11.7% in a 1 mile radius, 12% in a 3 mile radius, and almost 13% in a 10 mile radius. Other notable facts from this data is that 70% of the individuals that live in a 1 mile radius of Lake Dallas are less than 50 years old. So younger families with higher incomes.
Okay, I think this is back to me. This is John. So this is the overhead on the site plan. On the left-hand side, you'll see along Swisher Road, starting on the far left is the 7-Eleven pad, and then it wraps going east to the additional commercial pads. We'll talk about that in a second. The round circle there is the entryway into the multifamily, clubhouse, pool, a lot of green space, and all of the multifamily buildings in the back on this image here. The image on the right is just drilling in on the commercial. So again, the 7-Eleven has already contracted on the hard corner 1.5 acres. That 0.766 acres right there, we just got a letter of intent, as Ryan had mentioned earlier, from another QSR, quick serve restaurant. So we'll be working towards getting a final executed contract on that. And then the remaining parcels there include 2 additional strip centers and 1 more QSR as well. So just one thing to note, we really haven't done a lot of marketing on these retail pads, but just due to word of mouth, we've already got 2 pads already locked up. And I think once we kind of close on the land and get the signs up, I think there'll be a lot of interest and movement on the final pads that we'll sell off to retail developers. Next slide, please. So this is, really the bonus that we're all going to be able to participate in on this opportunity. If it was just a straight multifamily, those returns that Merrill had talked about earlier, kind of that 20 to 22% annualized return during the hold time for folks that are coming in with us on this phase 1, that's an amazing return in itself. But what it does not include are the sales of these retail pads. So as we sell off these retail pads, these sales and these dollars will actually go towards the project and benefit everybody on who's investing alongside us. So on the far left there, you'll see we're buying the land for $8.7 million. And as you kind of work your way across that row, these are the values that we think we're going to be able to sell those remaining pads for. And that's not to build these buildings. This is actually just to sell the dirt. It's to finish doing the grading of the dirt work and stub out the utilities, and that's it. After that, the commercial developers will come in, they'll buy the land for us based on these estimates and build them themselves. So if you go all the way to the right-hand side, the total retail, we think we'll be able to sell all those different pads for about $4.3 million, which is just under 50% of our total land purchase cost. So one way to think about this is that by selling all these pads, that's dropping our land bases by almost 50%, which is an exciting opportunity for this opportunity. So next slide, please. These are just some of our renderings from our architect at Investwell. It's just really good looking, modern, a lot of brick, different composites and colors. 3-story garden style surface parking. The one on the bottom there is just a rendering of the retail. We don't know what ultimately it's going to look like, but that's just a concept drawing on what that would look like off of Swisher Road. Next slide, please. And again, this is just to kind of show all the work that we continue to do and have already done with our architects, kind of laying out the different unit plans, optimizing the unit mix between 1-bedroom, 2-bedroom, and 3-bedroom based on our research and demographics. Spent a lot of time designing the floor layouts and the floor plans to accommodate, home offices for those folks that are doing a lot of work from home, doing a lot of Zoom calls from home. So we spent a lot of time working with our architect with these designs and these floor plans. Next slide, please. Hand it over to Merrill.
Okay, everybody, it's Merrill again. So I'm going to go over real quick just some of the high level costs of phase 1. So as you can see, everybody can see the slide. We incorporate land costs, closing costs, broker's commission. There's an acquisition fee. We do have a guarantee fee in here. And just for everybody, the question hasn't been asked, but it typically is asked. what kind of skin does the management have in the deal? So we're signing on these notes 100% personal liability. I'm not bragging about it by any means. That's just, those are the best terms we could negotiate right now in this market. So we're very incentivized to get this deal done and to move forward. We believe in it so much, we're literally putting all of our money where our mouth is. Pursuit costs, that number is a little bit light right there. These are the costs that have been expended on the property that John talked about earlier that we do to de-risk this investment. None of us on this team are land speculators. Land speculator is typically someone that goes and buys the land, hoping for something to change, hoping for zoning and entitlement, but at the same time potentially risking debt and equity in that hope. That's just not our model. Some people do it well, some people don't. We'd like to take the risk out. So pursuit costs are there. The lender's requiring an interest reserve. It's essentially 12 months interest reserve, $467,000. Lender's requiring a $100,000 contingency, which is pretty typical for the soft cost. And then the remaining engineer and architecture fees are about $760,000. There's some other things incorporated in there like landscape architect, MEP, mechanical engineering, and some other items. We just grouped that not to make it too overly boring. Occasionally people ask what the closing costs consist of. It's title, legal, and the lender's origination fee. And then off to the right, we're using a local bank that John and I, and primarily John, have a very good working relationship with. But also knowing that he and I and the whole team are very risk adverse, we're doing a 50% loan to cost on this. We want to make sure that we're not putting, again, anybody's capital at risk and avoid any potential problems with the lender wanting to take the property back. So there's plenty of equity in it. 8.5% is the current rate. It's interesting because that's actually a good rate right now. Not the rate we would like to have, but it's a good rate for right now. And the equity lift on this is about 5.7 million. Next slide. Okay, so you've got to have very good glasses to read this, and it's a good thing that good eyesight. It's a good thing that we're presenting this again for people to review afterwards. But this is a high-level summary of the anticipated production construction costs. Keep in mind, this is a very educated estimate. We won't actually go and bid this out until probably 6 or 7 months from now. But these are conservative costs based about 10% higher than what we're seeing right now. We like to estimate high and hopefully come in much lower. We will be using an owner's rep on these projects, and that's someone that is either of an engineering or architectural background. That's someone or some firm. Ours happens to be a firm. But they're basically our eyes and ears on the contractor, and worth every single penny. We've got another project John and I are working on. 2 of them actually were, I think it was about $6 million saved on one from the initial cost, and the bids we're looking at on another project working at right now, we've whittled down about almost 7.1 million. It's a large project, it's a $100 million project, but that's 7% right off the top without even getting into the details. So we're excited about this. Again, this is just kind of a high overview of ultimately the project's going to run about 71 million, including land, horizontal, vertical. So you can see right there kind of what it looks like. I'm going to give you one more painful slide to look at. Next slide. All right, so this is our projected pro forma. And if you look at this, basically what we're doing is I start with March of 2025. That's the anticipated date to which we have certificate of occupancy, and we can start leasing out the multifamily. It could be earlier, it could be a little bit later. There are always unanticipated construction delays. We like to think that because we're all doing development projects now, when a lot of the home builders are pencils down, we've already seen there's a large amount of labor that is now available that wasn't available before for construction because they're out of jobs, and some of the material costs are coming down. So we're cautiously optimistic that we meet or beat this timeline. And you just kind of see basically the thing that we like to look at are the units absorbed, which is kind of the second row. Just kind of, these are in our mind very low or conservative estimates of how many units will be leased up during the CO phase after we've got our certificate of occupancy and we're going through stabilization. We mentioned it, or it was in the video, that there are about 38,000 cars that pass this property in each direction. And for those of you familiar with North Texas, it is the only way to get from Little Elm and Frisco, or not the only way, but the quickest way from Little Elm and Frisco over to I-35, which takes you either north or south to downtown at the airport. So very, very heavily trafficked area, a great location for anybody working north or south up I-35. Next slide. Okay, and so these are just some, again, high level. These are our initial plans that we're working on with the architect. So you can kind of see the bed bath combination. We're not doing any 3 beds on this model. The market surveys that we're analyzing and the analytics that we're looking at don't show a whole lot of return on 3 bedrooms in this particular area. So you can see it's a pretty close mix of, I think it's 42 and 58, 1 bedroom and 2 bedroom. These are large units. We're averaging, I can't even read my own slide. We're averaging 905 square feet. That's an average size. Those are pretty good size units, which is good because people will gravitate towards those. Additionally, in areas like this where we have a surplus of demand and not enough supply, it does give the ability for people to have roommates. That's very foreign to us in Texas, but it's very common in places like the East Coast and West Coast where rents are high. So the nice thing is, while that's not the goal, that is an ability for people to have affordable housing if they need to double up. We're estimating, as you can see below, we pulled the latest comps to show everybody. We're estimating initially at about $1.62, $1.74. Actually, $1.74 is the rent right now in that area. We're very conservative. We typically, we didn't change our rent escalation year over year like a lot of underwriters might have done over the last 2 years. We've always kind of kept it at 3% plus or minus increase annually, and then we typically keep a 2 to 3% increase in expenses. We're running this with 3. You know, the feds are trying to get everything down to 2, but that's consistent. It's consistent with pre-COVID numbers, which we go back to. Next slide. Okay, so this is literally just a summary of the 3 slides back that had the pro forma. We just kind of put it in, you know, very easy numbers, group the numbers together so people can get an idea of what we're looking at. These are obviously estimated projections. They're subject to market conditions. We've put a very conservative sales cap rate at 5.25%, and we think it's going to be lower than that. And currently, the sales cap rate in North Texas for brand new construction is between 4.5 and 4.75. That's with the effect of the economic issues that are going on. So it doesn't seem likely it's going to go up another 50 or 75 basis points. But from our perspective, we'd rather assume that the sales cap rate is higher. And how can we look at this asset even with a higher rate? So this is kind of the way we stress test. And you'll see on the next slide a little more detail in the stress test. But 5.25 is where we expect it to be. And you can see at the bottom, the average price, sales price per unit is about $291 in year 1, and it slowly increases because you have rents that are slowly increasing. We have natural inflation that's going on. One note also about this particular property: there's only one other apartment complex of any type of competition that's fully leased up. After we start developing, there are no large parcels in this area. So we're very excited to kind of, and we happen to know the apartment complex owners on the other side. They're friends of ours, colleagues of ours. So great market, very excited about it. We're hoping that we actually get higher than 290 to 297. per door, but we run our numbers as if that's what it's going to be. Next slide. Yeah, and this is just a very high level stress test. Dark green is kind of where we think it's going to be. Don't really anticipate it being higher than 5.25. This is kind of the breakdown. These are all averages. We have different classes of investors, so I kind of grouped everything as an average. It's an average estimated return. If there's a 5.25 cap, the average return looks like it's going to be around 23%. For all the classes as a whole, that would range from 19 to 25%, depending on what class you came in, whether you come in now or you come in later. Later is obviously going to be a lower return, but still a good return. And you can see if the market cap rate, exit cap, is 4.75, that 23% all of a sudden increases to 32%. And that's on an annualized basis. So year 4 means your money's been out for 4 years. And so you see the total return at the bottom, it says 131.2. It's not difficult math. You take the 131.2 and you divide it by 4, and there's your 32.8% annualized return. That's for 4.75%. And to give everybody an idea, a year ago, new construction was literally selling at 3 to 3.25, maybe as high as 3.5. So we're estimating 4 years from now, when the market will definitely be different than it is now, different presumably in a better way. The Feds will have already gone through the cycle that we're in right now. And we're still estimating exit cap rates at almost 200 basis points higher than they were during 2021. So that's a very conservative underwriting. Next slide. Okay, so this is the last one you're going to hear from me. Everybody gave me the most complicated ones. I'm gonna start out. I'm a commercial real estate lawyer and an SEC lawyer. I am not a tax advisor, nor a tax consultant, nor a tax lawyer. So I'm going to give you really quick the highlights of the available benefits on new construction that you don't see if you're doing existing, and we do both. So long story short, they passed a revision to, these are just tax codes, 179D and 45L. These are specific codes that when you're building new construction housing, the government provides either tax credits or tax deductions. They don't, you can't take them though until you've got your certificate of occupancy and they've been, if it's a multifamily, been leased up. So as they get leased up, you get to take them. So very high level, 179D for anything that is constructed starting in 2023 or later. And I'm going to give you the max deduction. The max deduction is $5 per square foot. Okay. So essentially they're saying is for every $5 per square foot, and that's living square feet, so rentable square feet, that comes as a tax deduction. That's the max. We're shooting for the max. The max is based on how green it is, and typically we're building to a very green standard. And then the second big component is how much does the labor cost? In other words, the labor that we're using on these projects, are they at or above the minimum standard the government sets? And as far as the standard today, we seem to be above. Like it to be lower, but it is above because that's what market is paying. But we get a benefit from a tax deduction. So potentially we could get $1.5 million as a tax deduction when this is completed. And that's 1.5 million on the fund level. So that gets distributed pro rata to all of the investors. On top of that, the government also provides a tax credit. And for those of you that aren't familiar with the difference between tax deduction and tax credit, a tax deduction is basically we take all of our income minus our deductible expenses, and you pay taxes on it. The tax deduction, so if you have 1.5 million tax deduction, let's say you're an individual and you get 1.5 million, you made 2 million last year, it reduces your $2 million down to $500,000. You get to take 1.5 million as a deduction, and now you're only taxed on 500,000. That's a huge benefit. Again, this is pro rata over everybody, so it's not going to be 1.5 million to 1. A tax credit is different. So a tax credit is actually 2.5 times better than a tax deduction, depending on your tax bracket. I'm not giving tax advice again. I'm just making generalized statements. But in that same scenario where you have a $500,000 tax bill, if you're in an investment like this and you get on your K1 a $25,000 tax credit, you get to offset your tax bill dollar for dollar. That is huge. So in building new development right now, and the government is painfully aware of the shortage of housing that we have, they've instituted these provisions. So on the tax credit side, which goes hand in hand with the tax deduction, meeting some of the basic same standards, we get up to $5,000 per unit. So I'm gonna remind everybody again, it's 340 units. So $5,000 times 340 units is up to $1.7 million in tax credits. So for those of you that already invest in existing, you're probably familiar with bonus depreciation or accelerated bonus depreciation, which is tapering off. It may come back if there's a different change in government and they want to bring it back. It may not. You're always going to get depreciation on assets, but the bonus depreciation allows you to squeeze a lot of years down to year one. So these are separate and aside from that. So again, I'm gonna go over real quick. We're estimating up to $1.5 million in tax deduction and up to $1.7 million in tax credits. And if for whatever reason, maybe subject to market conditions, or we refinance at a great rate and it makes sense to stay in this asset a little bit longer, we then can start exercising, we'll start getting the benefit of depreciation expense on top of all of that. So there's a lot of good, didn't mean to confuse anybody, but there's a lot of good tax benefits that are associated with new development as well as existing. But new development has an additional tax deduction and tax credit that gets moved on down to all of the investors. So it's good. And I would advise that you do check with your CPA to see if you qualify for tax deductions and tax credits. Majority of people do, but again, I'm not a tax consultant, so I can't say yay or nay. So now we're going to hear from Jeff Satz. He's the COO and he's in charge of the subscription process as well.
Hi, good evening, everyone. So I'm Jeff Satz. For the capital raise portion of this, I'll be your primary contact. By tomorrow, everybody will have a link to our deal room. The deal room, there's 2 pages on the deal room. The first one, you'll fill in your basic information, the type of investment, whether you're doing it as an individual, an entity, trust, self-directed IRA, et cetera. As when you hit submit on that, you'll be taken to page 2. Page 2 will load up the DocuSign subscription booklet. It'll have just about all of the fields already filled out. It'll allow you to review it, and then you could sign it there. In addition, if you want to take your time reading it, DocuSign will send a daily reminder for that. Once the documents are signed, you will get an automated email from our portal asking about your accreditation. So there are 2 primary ways to become accredited. The first is we'll provide an affidavit that can be signed by your CPA, attorney, investment advisor registered with the SEC, or a registered broker-dealer. The second method is we work with a third-party firm out of California called Verify Investor. You would work with them directly to upload all of your supporting documentation. We have no visibility to that whatsoever. Once they verify your accreditation, they will issue you an accreditation certificate. We will get a copy of that, and we will add that to your files. Typically, we will do not provide wire instructions until we verify the accreditation. But because of the short time frame before close, once your documents are signed and you receive that accreditation email, I will also reach out and provide wire instructions at that time. We'll run those processes in parallel. We are requiring all of the funds to be wired in by next Thursday, April 20th. But just keep in mind that since it's a 506C, accreditation verification is required. So that will need to be completed regardless of funding in order for you to maintain your position in the syndication. Once we receive funding, we will be sending a confirmation email the next business day after wire receipt. And then also next week, we'll be opening up our investor portal. If you're not currently a user on there, we have an investment portal called Tempest. You will receive an invitation to that. That is the platform that we use you'll have access to your docs, of course, in there. Future tax statements will be loaded in there. And then we do monthly newsletters and publish financials, and all that will be inside of that portal, all in one place. We are reserving the positions. It is a first come, first serve. There are very few slots available. And then the documents that you see, they will be signed by John Montero, one of the sponsors. So.
I would add to that real quick. So we've designed this system in-house. Actually, Jeff has programmed it. So it's very, very easy to go through. If you want, you literally could do it with your iPhone or whatever brand phone device you have. So we do make it user-friendly, notwithstanding Ryan and Juan and all of us are available for any questions. If you have anything, reach out. If you're in the document process, Jeff will be available as well. We always have questions, even though it's relatively easy. And again, just to reiterate, we're about 80% subscribed already. So if you're interested in doing this and getting into this project, highly recommend you guys sign up as quickly as you can. If you have questions, there were not a lot of questions on the webinar, so we did a really good job of explaining it, or everybody's sleeping, or it could be a combination of the two. But if you have questions, please feel free to reach out to Ryan or Juan, and then we'll all respond, and we respond very quickly. We've gone through this probably 33 times, not this particular deal, but raising funds. So there's really no question that that's a dumb question. And if you're thinking you should ask a question, but you're embarrassed to ask it, I promise you someone else has the same question.
Yeah, just to add, so verify investor, I see the question pop up there. The costs are covered by us. There is no cost to you. We would, if you use that service, we will send you an invitation link. Once you click on that and you kind of go through the process, there is no charge to you. And then I also want to mention, if you actually have an accreditation certificate from a recent syndication that you did, feel free to email it to us and we'll take a look and see if we would be able to accept that or not. Okay, Ryan, want to close it out?
Yeah, so thanks again for joining us today. We appreciate you being here. Feel free to text me, text Juan, reply to the emails. We're going to be sending out tomorrow links to the deal room if you haven't already logged in. We'll be sending the full deck. We'll be sending a recording of this webinar, and we'll be available by phone or by Zoom if you'd like to kind of get into more details or if you have any questions that need to be answered. But we appreciate you being here. Thank you and have a great night.
Thanks, everybody.
Thank you.
Thank you.